In today's video, we are going to discuss the waiver of premium rider and the impact that it has on a whole life insurance policy. We're going to look at illustrations with and without a waiver of premium rider and provide as much detail as we possibly can, really to help you decide if the waiver of premium rider is something you want attached to your whole life insurance policy or not. And quick side note, if your goal is to have a whole life insurance policy that is set up for maximum cash value, adding riders, such as the waiver of premium rider, will result in a little bit of drag. The more riders you attach to the policy, the added cost there is. So what that means is A, you'll cover that additional cost with more money out of pocket, or B, the money you are already paying into the policy, some of it will be used to cover the costs of the rider. In this case, the waiver of premium rider. So there are benefits to it. However, let's go through the pros and cons. And again, we're going to see illustrations with and without this rider so you can better understand it. What it does, why one would be attracted to it, is in the event that you become disabled due to sickness or injury, the base premium is waived. And what that means when I say the base premium is waived is that it's paid by the insurance company. So for example, if you have a policy and you're paying a base premium of $10,000 per year, and you get injured, whether it's on the job or not, but you can no longer perform, you can no longer work, what'll happen is if you've got this rider attached at issue, so you will have to have attached this rider when you first started the policy, the company will waive it. They say, okay, you're totally disabled, you can no longer work, so what'll happen is you don't have to pay this premium, but this $10,000 base premium is still paid by the insurance company each year. So they end up funding it for you. So you'll see that cash value continue to build up. The death benefit will appreciate as well. So you'll see it constantly compound. So there is an advantage in that respect. Now, next point, PUAs. When it comes to policy design, which we talked about in our last video, and we talk about it all the time, what takes that biggest bite out of cash value? The base premium. So the name of the game is, when it's a maximum cash value policy, is how can I reduce that base premium as much as possible and then pay as much money as possible to the PUA rider. That's how we maximize cash value. So if I have a basic waiver of premium rider, that waives the base premium. It typically does not waive PUAs. However, if you have a scheduled PUA rider on your policy, you can set it up, the waiver of premium rider, to waive the scheduled PUA payment. Unscheduled PUA payments may not be waived. So what I mean when I say this is, let's say you've got a policy where you are paying in $100,000 per year and you've got a base premium of $10,000 per year, and then you have a scheduled PUA rider of $90,000. And we'll assume that $90,000 also includes the term rider you have attached. So total of 100, base premium of 10, scheduled PUA 90. If you've got a scheduled PUA payment, what that means is that you're getting a bill every single year for $100K and you're paying them all at the same time. So if you have your policy set up in that manner, typically you can attach that waiver of premium rider to both the billed premium and the scheduled PUA premium. Now that scheduled PUA payment, you can reduce it after the fact. If you reduce it, what you will likely see is the cost, the waiver of premium, the cost for the scheduled PUA payment is going to be applied to the amount that's actually being paid in. And then on a side note, people we work with, if they've got a policy like this, where you're paying in $100,000 per year, will usually set the PUA rider up to be an unscheduled PUA, meaning they're only committed to the minimum amount and can make additional PUA payments at their discretion. So let's provide a little bit more information. If we look at some literature from a life insurance company, what do we have here? Waiver of premium. So the waiver of premium rider, here we go. Premiums will be waived while the insured is totally disabled. And then we've got some terms here as far as when we qualify for the waiver of premium rider. So the disability continues for at least 6 months. So first we have to be disabled for 6 months, meaning if I'm on the job today, I get hurt tomorrow, the next day I won't qualify for that waiver of premium rider. We're going to see that it's at least 6 months first. Now, premiums will be waived how long? For as long as the disability continues. So if you get in a serious accident or you're diagnosed with an illness that just completely changes your life and your entire plan of what you had for the policy is now altered, you can't get the money in that you thought because of the disability you have now, that's where this rider is beneficial, and the premium will be waived as long as that disability continues. Now we've got some terms here, and different companies will have different terms and such, so we want to be aware of this. Depending on exactly when we start that waiver of premium rider, meaning when we become disabled. If it begins before the age of 60 and continues to 65. We've got some other literature down here. Here we go. The rider terminates at age 65 unless premiums are being waived. So what I want to hit on this point is, let's say you are 45 years old. Let's say you start the policy at 40. At 45, something happens and you have to go on disability. You can no longer work and you're classified to be totally disabled as far as what your job was based on your occupation when you first took out the policy. So you cannot work, and let's assume you have an L95 policy, which is what this is, which means premiums are due up until the age of 95. What will happen in this particular case is the premium will now be paid until age 95, whatever that base premium is in this particular case, or the amount we have the waiver associated with. So in this particular case, age 45, we became disabled. The waiver continues through age 95. Now here we see that the rider terminates at age 65. What this means is if you never use the waiver of premium rider, or maybe you did for a short period of time, but you're no longer on it, and then age 65 comes, and then you become disabled after 65, the rider would have fallen off. It's no longer attached, meaning that waiver of premium rider is attached to the policy up until age 65. And the only way it would remain in force is if you went on disability claim and exercised the waiver of premium rider before turning 65. I hope that made sense. And then we've got some other bullet points here. The last bullet point I'll add real quick, where we see that this rider does not waive the PUA premium or OYT, which represents 1-year term costs, which are typically paid for by the dividend. You can attach a rider, you can elect the waiver of premium rider to cover the 1-year term cost and a scheduled PUA rider. If you exercise that in the illustration, you'll see this a little bit different as far as the language is concerned. We will have to have elected that waiver of premium to be applied to the base premium, term cost, and scheduled PUA rider. If we don't, then it won't waive that. So let's take a look here. Let's go back to the whiteboard first. So if we look at a policy, let's assume you want to pay in $100,000 per year. And we'll assume we've got the breakdown here, $9,000 to the base premium, $1,000 to the term rider. Combine those two, $10,000 scheduled. Then PUA, $90,000. This could be scheduled or unscheduled. And again, most people we work with will set this up where it's an unscheduled PUA rider. This way they are not committed to it. They're committed to 10 and can add more funds to the policy at their discretion. Waiver of premium rider. Here we go. So if we attach that, I want to know, what am I getting and how much does it cost? So let's take a look here. So what we'll begin with is an illustration without the waiver of premium rider, which this one has it. Here's the one we want to look at. All right, so if we scroll down here, what do we see? We see a breakdown as to where his money is going. Base premium, scheduled PUA rider, which again, normally this would be unscheduled. Here's the 1-year term cost. So his true minimum commitment are these two. How this 1-year term cost, we see 1-year term over here, how that is covered in this illustration is the scheduled PUA payment first covers the 1-year term cost, and then everything else comes back to PUAs. But this is just a high cash value policy funded at $100,000 per year for 10 years. We see first year cash value, 83 and change, break even just about year 5. And then by year 10, you've paid in $1 million, you've got 1.141. So there we go. Take a look at this. Exact same policy or illustration with one change. Waiver of premium is attached. The waiver of premium, in this example, we attached it to waive only the base premium. So if this is your policy and you become disabled, here we've got $100,000 per year going in, what would be waived is only the base premium piece. So is it worth it? Well, I want to hit on two things. First, let's see what it would look like in terms of cost if you decided you wanted the entire $100,000 waived. And to do that, I want to iterate a very important point here, is if you want to waive the full $100,000, that means you are paying the full $100,000 upfront every single year. You're being billed for that. If you want the ability to commit to the minimum and then add the excess $90K up to a total of $100,000, that would be a case where we have an unscheduled PUA rider and the waiver would not apply to the PUA payment. I just want to make sure I hit on that. So let's take a look here. What do you notice? Waiver of premium rider. So we've got the same base premium, same net out of pocket with $100K. Here's the waiver that covers the base premium, but then here's the waiver cost that covers the PUA payment. Why it is significantly higher is because the PUA dollar amount is significantly higher. What the insurance company is doing here is saying, okay, if you want to waive this dollar amount, it's going to cost you more to insure it. So this is the fee that goes to the insurance company every year, and if you become disabled, you know that PUA payment will be waived. If you do not become disabled, that is money you spent in rent for that coverage. So do we want that? Here's what I'll add. Most people will elect against it, and here's why. If I've got a high cash value policy, so here's the example without the waiver of premium, what do you notice here? Funding for 10 years. Let's pretend after 2 years, this is you get disabled and you cannot pay anything in, not even the base premium. What you could do here is something like this. Exact same policy. First 2 years, the cash value is identical, same thing with the death benefit, but then zero out of pocket. What we exercised here was a premium offset option. We're assuming life happened, he couldn't pay anything in. Maybe he just decided he doesn't want to pay anymore, but here we're pretending it's a disability, premiums still due. We did not attach the waiver of premium rider, but because we max funded the policy, we 10x'd our base premium. The policy only has to cover the base premium and the cost of the term rider, but it easily continues to appreciate. Then we also cut the term rider, exercised a reduced paid up here after year 7. But my point is if a policy is set up for maximum cash value, then a lot of times we have that protection there just by designing it appropriately. And if someone's in a position where they're just moving cash from one asset to another, then they might not need the waiver at all. But again, it's good to be familiar with the different options. So overall, the waiver of premium rider is a good option to be aware of. If you are interested in a policy for death benefit, it's a very attractive option. It ensures the premium is continuously paid. If you're interested in it for cash value and you've got cash on hand, or you know you're going to be able to fund the policy, from experience, what I've heard from a lot of people is, you know what, if I fund the policy correctly in the first couple years and something does happen, which I think the chances of that are rare, if something does happen, then I'm comfortable running the table without it. Like I'm comfortable taking a policy without that waiver of premium rider. But you might look at it and say, hey, I would like it. Point is awareness here. So I hope you enjoyed this video. If you did, please hit the like button, subscribe for more. If you have any questions, please leave them in the comments below. And as always, I hope this helps. Thanks so much. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.